Welcome to The Deep Dive, your shortcut to being instantly well-informed.
Glad to be here.
Today, we are tearing into, well, honestly, one of the most confusing earnings reports I've seen this quarter. DraftKings, ticker DKNG, their Q3 2025 results.
Yeah, it was a real head-scratcher initially.
Absolutely. So our mission here is to figure out how they managed to deliver this pretty massive revenue miss, reset their guidance downwards pretty significantly, and yet the stock just executed this violent reversal, closed the day up over 8%. It doesn't quite add up on the surface.
Right, that divergence, that's really the key thing we need to unpack. The volatility around the announcement was pretty extreme. And you look at the immediate headlines, they were brutal.
Yeah, tell us about those top-line numbers.
Okay, so GAAP EPS, a loss of 52.6 per share, but maybe more importantly, the non-GAAP adjusted EPS. That was a loss of $2.26. And the consensus, the analysts, they were expecting something much closer to break even, maybe even a tiny profit, like a cent. So a big miss there.
And revenue didn't help matters either.
No, not at all. The top line came in at $11,144 million.
Which, okay, sounds like a big number, but context matters.
Exactly. It missed even the lowest end of what analysts were expecting. That range was more like $1.26 to $1.4 billion.
Yeah.
So yeah, a substantial miss.
And the growth rate.
That's the other kicker. Year-over-year revenue growth was only 4.4%. For a company like DraftKings, in this space, that's, well, shockingly slow.
Okay, so horrible numbers, basically. You'd think the stock would just get absolutely hammered.
But you'd expect. And initially, pre-market, it did drop. Quite significantly, actually. Dipped down into the mid-20s. But then, something changed. Through the trading day, it staged this incredibly powerful reversal. Finished up 8.65%, closing at $30.40.
On heavy volume, too, right?
Huge volume. 42 million shares traded. So this wasn't just a little bounce. This tells you something really important.
Which is?
Big money, institutional investors. They looked straight past those ugly Q3 numbers. They heard what management was saying about the future, and they bought it. Literally.
All right, so let's dig into why that future narrative was so compelling that it overwhelmed the bad results. Starting with the Q3 disaster itself. If customer engagement wasn't the core problem and this stock bounce suggests it wasn't what was the killer, what tanked the revenue?
It was, basically luck. Or rather, bad luck for DraftKings. Management called it, very dryly, customer-friendly outcomes.
Right. How much are we talking?
They put a number on it. Approximately $300 million in headwinds, just evaporated revenue, mainly from a few big NFL games in September and October where the bettors just cleaned up.
Hold on, $300 million. That's massive. That's the size of some entire companies. Does that suggest maybe they didn't manage risk properly on those specific games? Or is that just like the cost of doing business in sports betting?
It's a really fair question. Management insisted their risk limits were in place. They argued this level of variance, while definitely painful and maybe rarer than they'd like, it's just inherent to the sportsbook model. And look at the underlying numbers. They back that up to some extent. Sportsbook handle, that's the total amount wagered, was actually up a strong 10% year over year. Hit $11.4 billion.
So people were betting more than ever.
Exactly. Customers were super engaged. But because those outcomes went so heavily against the house, that $300 million hit meant sportsbook revenue actually fell 9% year over year.
Wow. Handle up 10%, revenue down 9%. That really highlights the volatility.
It's brutal. It just reminds you, DraftKings is running this huge financial model that's ultimately tied to, unpredictable human performance in sports. You can model trends, but you can't perfectly predict every upset.
Okay, so core betting activity, healthy. Short-term results, disastrous due to luck. Let's pivot then. What about the other parts of the business? iGaming, user metrics. Did they provide that buffer?
They absolutely did. And this is likely what those institutional buyers were focusing on. If you look past the sports outcomes, the underlying customer metrics look really quite healthy. Monthly unique payers, MUPs, came in at 3.6 million.
Which sounds, okay, what was the growth?
Well, initially it looks like only 2% year-over-year growth, but, and this is important, you have to adjust for the Jackpocket acquisition. If you exclude that impact, the organic MUP growth was actually 6% year-over-year.
Okay, 6% organic growth, that's solid. And are they getting more money out of each user?
Yep. ARPMUP, average revenue per monthly unique pair, that grew 3% year-over-year to $106.
So more users, and each user spending a bit more. That points to good cross-selling, keeping people engaged.
Exactly. Good execution on the platform side.
And what about iGaming, the online casino side? That's usually less volatile.
iGaming was definitely the star of the quarter. Revenue there accelerated strongly. It jumped 24.9% year-over-year to $451 million.
Almost 25% growth. That's significant.
It really is.
Nice.
And what's interesting is that's the fastest iGaming growth rate they've posted since the first quarter of 2024. So that part of the business is compounding very nicely, providing that crucial higher margin cushion against the sportsbook swings.
So healthy user growth, strong iGaming. The board must have seen these same underlying strengths because their reaction wasn't panic. It was, well, aggressive confidence, wasn't it?
Absolutely. Double down, you could say, immediately. Alongside cutting guidance, the board announced they were doubling the share repurchase authorization from $1 billion up to a massive $2 billion.
Wow. $2 billion in the face of cutting guidance.
Exactly. That's a huge signal to the market. It screams that management believes the stock is way undervalued compared to its future free cash flow potential. They're saying, we believe in the long term, and we're putting serious money behind it to support the share price.
You just don't authorize a buyback that enormous if you think the fundamental profit engine is broken.
No way. It signals deep confidence in the structural trajectory.
Okay, which brings us perfectly to the CEO's tone on the call. He actually said, quote, "This is the most bullish I have ever felt about our future." Which sounds kind of jarring when you've just slashed your forecast. How do they square that circle? Bullish tone, bearish numbers.
It's definitely a narrative tightrope walk, like you said. But it's strategic. Look at the revised guidance. Full year 2025 revenue now expected between $5.9 and $6.1 billion. Adjusted EBITDA between $450 and $550 million.
So the cut basically flows through that $300 million Q3 hit.
Pretty much. It resets expectations, lowers the bar for the next few quarters. And by hammering home the message about long-term structural improvements, they're basically telling investors, look, Q3 was bad luck. It was temporary. The underlying machine is getting stronger.
Okay, so what are those structural improvements they're pointing to? It can't just be iGaming growth. Where's the long-term margin expansion coming from in the core sportsbook?
A lot of it comes down to steering better behavior. Specifically, getting more people to bet on parlays. They talked about the structural sportsbook hold, that the percentage of all bets they expect to keep over the long run is improving. Why? Because the mix of bets is shifting heavily towards parlays.
Right. Parlays are much higher margin for the house. They mentioned some big jumps in basis points, didn't they? Can you translate that for us? 800 basis points, 1,000 basis points. What does that mean in simple terms?
Good point. So 100 basis points is just 1 percentage point. Pretty simple. So for the NFL season so far, the mix of bets that are same-game parlays, that's up 800 basis points. That means 8 percentage points more of the total handle is now coming from these high-margin parlays compared to last year. It's a huge shift.
An 8% shift in mix year over year?
Yeah.
And the NBA.
Even bigger. For the NBA season to date, the same-game parlay mix is up 1,000 basis points. That's a 10 percentage point jump.
Wow. So customers are really embracing these things?
They are. And because of how parlays work, you have to win multiple legs. The house edge, the vig, gets compounded. The more people bet parlays, the higher DraftKings structural profitability becomes, regardless of whether one specific favorite loses on a given Sunday.
So putting it together, management is telling the street, we're optimizing for long-term expected value, or EV. They're building a mathematically stronger betting profile, which means that they accept that sometimes they'll have these huge, rare swings. That's the high short-term volatility, the high beta. But the trade-off is better average returns over time, the higher EV. Is that the gist?
That's precisely it. They were clear they still manage risk on individual events. They won't let liability get out of control without hedging. But within those bounds, yeah, the goal is EV maximization. It's a really important strategic choice. Aim for the highest possible long-term profit, even if it means quarters like Q3 might happen occasionally. Higher margins, but maybe a bumpier ride quarter to quarter.
Okay, makes sense. Now, looking forward, the market always needs new reasons to believe, new catalysts. What did they highlight on the strategy front? New products, expansion.
Yeah, the big new thing they talked about is the upcoming launch of DraftKings Predictions. This is their move into prediction markets or pari-mutuel style betting. They need licenses first, of course. They framed it as a significant incremental opportunity, something totally new.
But they also said it's structurally limited compared to traditional sports betting, right? So why the big push?
That's the interesting part. It's structurally limited in terms of like the depth of markets compared to regular sports betting. But the strategy is clever. They plan to focus investment primarily in states that don't currently allow online sports betting.
So using it as a way into currently closed markets.
Exactly. Which is still, believe it or not, nearly half the U.S. population lives in those states. So they see it as a way to acquire users, build a database, establish the brand in places where they can't offer sportsbook yet. And because it's a new product with limited data, they're being careful with spending, aiming for much faster payback periods on customer acquisition costs compared to the, say, 3-year target they use for sportsbook or iGaming. Sort of a low-risk entry play.
Smart. What about regular sportsbook expansion and partnerships? Any updates there?
Yep, they mentioned expecting a sportsbook launch in Missouri once they get the final approvals. That's a decent-sized Midwestern market.
Yeah,
And critically, they talked up new exclusive marketing deals with ESPN and NBC Universal.
big names. What's the angle there?
Deeper reach, obviously. But they specifically mentioned unmatched NBA access through these deals, claiming it's already driving significantly higher market share for early season NBA betting compared to last year. So using media partnerships to grab share. And one more thing on the product side, they're rolling out a Spanish language app.
Oh, interesting. Why now?
Timing. It's ahead of the 2026 World Cup, which will be partly hosted in the U.S. They're clearly targeting that huge, passionate, and fast-growing demographic, anticipating massive betting volume around that event. It shows they're thinking multiple years ahead.
Okay, good overview of the company's specifics. Let's zoom out a bit now to the sector context. We know DKNG had its own unique bad luck in Q3, but was the whole online betting industry kind of weak leading up to this?
Yeah, definitely. There was a noticeable chill across the sector.
Yeah.
If you look at the main sector ETF, BETZ, it was down about 13.5% in the 3 months before DraftKings reported. That signals general investor caution, maybe some softness in overall betting trends.
So the backdrop was already pretty negative.
Right, which probably amplified the pre-market drop for DKNG, but also helps explain why the reversal was so strong. It likely crushed a lot of short sellers who were betting on disaster, piling on because of both the sector weakness and the known Q3 outcome issue.
Yeah, that bounce fueled by shorts covering, plus the institutions buying the long-term story. And ironically, that guidance reset actually makes the next few quarters easier to beat, right? It lowers the bar.
It absolutely does. So the near-term setup now looks kind of interesting.
What should people be watching for specifically?
Okay, key catalysts to track. First, the timing of that predictions launch. Does it happen quickly? Second, the Missouri Sportsbook go-live date. And probably most importantly, just watch the Sportsbook hold rate. Does it normalize? If that Q3 bad luck really was just short-term variance, we should see it even out, maybe even swing the other way through the rest of the NFL season and especially the playoffs. That could mean a huge revenue tailwind in Q4 and Q1.
That makes sense. Oh, and they added someone new to the board, too.
Yeah, good point. Greg Wendt. He's got a long background in investing, and specifically in the gaming sector, brings a strong capital markets viewpoint, which seems very relevant given they just authorized that massive $2 billion buyback. Add some credibility there.
Okay, great context. Now, before we get to our final segment, we absolutely have to say,
Yes, let's be crystal clear. This is not financial advice. We're analyzing the earnings call, discussing the company's strategy and the market reaction. Any trade idea we discuss now is purely for educational purposes, a thought experiment based on the information presented in the call. Please do your own research.
definitely. That said, that wild intraday stock reversal tells a story. Big investors are clearly betting that the bad luck was temporary and that the catalysts are real. So here's our outrageous but plausible trade idea, synthesizing everything we've just talked about. It's a pair trade, a high conviction bet on DraftKings, but specifically relative to its peers.
Right. The thinking is the market verdict on Q3 was temporary blip. The $300 million hit from outcomes wasn't seen as a structural flaw. And you've got that $2 billion buyback acting as a potential floor under the stock price, a signal of internal confidence.
Yeah.
So you're betting on DKNG's specific story, driving it higher, faster than the rest of the sector.
So the concrete idea, go long DKNG stock and simultaneously go short the BETZ ETF, which represents the broader online betting sector, and the time frame. Maybe hold it through Q1 2026.
Yeah, the rationale for that timing is twofold. First, you're betting that the sportsbook hold rate fully normalizes, maybe even overshoots positively, during the high-volume NFL playoff season, boosting DKNG's Q4 and Q1 results specifically. Second, you're betting that positive news flow around the launch of DraftKings predictions, plus maybe progress on the World Cup strategy, creates enough company-specific excitement to pull DKNG stock away from any lingering pessimism or weakness, dragging down the overall BETZ sector.
So essentially betting DKNG's unique catalysts will let it outperform the industry headwinds.
That's the thesis. Betting on normalization and specific execution.
Okay, let's quickly recap then. DraftKings Q3 2025 looked like a disaster on the surface, no doubt. Really bad sports outcomes, hammered revenue. But management used that moment of volatility to double down on their long-term vision. They pointed to structural hold improvements from parlays, exciting product innovation like predictions, deep partnerships with ESPN and NBC, and backed it all up with that massive $2 billion buyback.
Yeah, they basically weathered the storm and tried to refocus everyone on the horizon. Which leads to our final provocative thought for you, the listener, to chew on. Management explicitly said they're focused on maximizing long-term expected value, even if it means higher short-term volatility like we saw in Q3. So the question is, will investors really tolerate that? Can they stomach potentially shocking quarterly swings driven by unpredictable sports results? Or, over time, will the market demand that the steadier, less volatile iGaming and maybe these new prediction markets become a much larger essential buffer to smooth out those earnings?
A fascinating question. The ultimate stress test for growth stock investors, perhaps. Thank you for joining us for this deep dive into DraftKings' eventful Q3 2025 call. As always, we encourage you to dig into the data yourself.
Yeah, definitely worth exploring further.
We'll talk to you next time on The Deep Dive.